The jobs market is staying tight. That's our topic for today's Backstage Pass. Stocks have opened the day higher today. Mortgage bonds are up as well. Mortgage rates are going to open about where they closed off yesterday, but if the MBS continues to improve throughout the day, we could see some pricing for the better. We'll be on the lookout for that and let you know. But first, let's talk about what's going on as far as data goes today. Today we got initial jobless claims, and that data showed that initial jobless claims decreased by 2,000 last week, and then the previous week before that was actually revised 5,000 lower. Continuing claims decreased by 19,000. And so this data is really showing us that the jobs market is staying pretty tight, and it's been staying pretty tight consistently for the past few weeks. Now, the impact on that in the greater economy and into mortgage bonds, which is what we're concerned about, is this. It's an indirect indicator of how the economy is doing. And basically, the way it boils down to is this. The Fed's activities to fight inflation is what is known as quantitative tightening, all right? So what they're doing is they're raising the Fed fund rate. They are reducing the amount of excess cash that's in the economy, which should in turn lower demand in the economy, which should in turn cause some companies, as demand lowers, to lay off workers or pause hiring activities. So the quantitative tightening and what the Fed is doing to fight inflation indirectly should cause fewer jobs and some the jobless claims to go up. But we're not seeing that happen on the jobless claims numbers on the jobs market. So the jobs market is staying very tight, and it's an indirect indicator of what's going on in the economy. So what we expected from the bond market as we saw this data today, what would be normally expected is an adverse reaction from the bond market. The bond market would typically have seen this as an indication that the Fed's fight against inflation is not working as well as they want it to. But however, the bond market has been counterintuitive for the past week and a half, 2 weeks. So whenever there's been news that the economy is tightening, the bond market has reacted negatively. That's counterintuitive to what you would think. Whenever there's news that the jobs market is better than what was expected, the bond market, mortgage bonds are up today. Mortgage bonds are up 8 basis points at the time of recording. The 10-year yield is down 2 basis points. Now, there are some technical levels that could be contributing to this, but it's just a little bit counterintuitive to the news of the day. Mortgage rates yesterday, the national average on the 30-year fixed closed out at 5.84, a little bit higher than what we were expecting. Today, we're looking at about 5.81 is what we're expecting for the 30-year fixed for national average. Again, if mortgage bonds continue to perform and outperform today, we could see some repricing for the better. One of the things that is happening later today is a 7-year Treasury note auction. That has the potential to be a market mover if there are any surprises. If it's met very weakly, the bond market could react negatively. If it's met with a lot of demand, bond market could react positively. So we will wait and see if that has any effect on the market later today. Now, tomorrow we have 2 major events and news items that are coming out tomorrow. Number one, Jerome Powell, the Fed chairman, will be giving a speech at 10 a.m. Eastern at the Jackson Hole Symposium that's going on in Wyoming right now. Now, that speech will be an indicator of what the symposium as a whole is thinking, and that's leaders from other central banks from across the globe, including obviously Fed Chairman Jerome Powell. So that speech is going to be an important speech and give us some insight into what global central bank leaders are thinking as far as inflation and kind of laying out a roadmap for what they plan to do continuing going forward. But the other news item for the day tomorrow is going to be PCE, personal consumption expenditures. And this is the Fed's favorite measure of inflation. So a couple of big news items that are going to be coming out tomorrow, and the reality of it is that these items, the speech and the PCE data, they're both going to be market movers for good or for bad. We are hoping that mortgage bonds respond very positively. The mortgage bond price goes up, and we should see rates come back down. That's the hope, but the reality is we're not sure what's going to happen, so we'll have to wait until tomorrow to see. But until then, remember, stay positive. I hope you have a great day today and tomorrow. Remember to like, comment, and subscribe if you haven't done so already. If you haven't subscribed, make sure you subscribe and hit that bell icon to get notified about these updates every day. Again, have a great day. and we'll see you tomorrow.